that we only broke through 30 very briefly. I thought we were going to go 50-week moving average here, a 50-day moving average here. Yeah, the 50-day moving average. I wouldn't be surprised if we went to 28, but we didn't go that low. So we'll see what happens here. It looks encouraging. And could it be that this will be a repeat of 2010 where we broke 20 briefly and then headed up to 30 and then to 50? It could be. $50 for a valuable piece of real estate. He's not specifying here exactly what valuable piece of real estate that could be. I'm just saying it's a house or it could be a building or whatever it is. So $50 at $20.67 is about 2.4 ounces of gold for a house. Multiply that by 16 at a 16-to-1 historic monetary ratio for silver, and that's about 39 ounces of silver for a house. So 75 ounces for a swanky, nice place in Berlin, and 39 ounces of silver for a run-of-the-mill family home, let's say. I still believe this is going to happen.
The prospect of silver reaching $50 an ounce again ignites interest and debate among investors. Historical precedents in 1980 and 2011, when silver briefly touched these levels, showcase the metal's potential to spike under the right conditions. The drivers behind such peaks often include heightened market sentiment, fear of inflation, a declining US dollar, and significant industrial demand. Regarding the gold-to-silver ratio, Rafi Farber notes a trend from 2011, where the ratio was about 30-to-1, to peaking around 65-to-1 during the silver squeeze, while recently hitting 76-to-1. He speculates that breaking this long-term trend line could trigger a major silver rally, potentially after a brief bounce. According to GSC Commodity Intelligence, the last time silver prices broke above $32 an ounce, the precious metal went on to trade at $50 an ounce within 100 days. If this is a leading barometer for predicting the future performance of silver prices, then this ultimately means one thing: higher silver prices are coming. Drawing parallels with past movements, Farber points out that silver saw a significant rise after breaking the $20 mark in 2010, despite a few days of trading below that level. He is optimistic about the current market dynamics and believes a significant rally could be imminent. According to Reuters, precious metal prices have risen in the past 1 to 2 days as Treasury yields have fallen, enhancing metal's appeal as a safe haven for investor portfolios. Meanwhile, the price of silver experienced a decline of over 8% from the 29th of May to the 4th of June. Today's rise is an attempt by bulls to offset this bearish momentum, during which the price of gold remained stable. Reflecting on hyperinflation's impact, Rafi Farber discusses a scenario from Benjamin Roth's Great Depression Diary. In 1923, Germany $50 could buy valuable real estate, equivalent to 39 ounces of silver. Farber predicts a future where 75 ounces of silver might secure a high-end property. Now, we present the clips of Rafi Farber's insights from his recent video with Arcadia Economics. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Gold to silver ratio. Looking back to 2011, we have a trend line here from 2011 when it was about 30-to-1 to 2021. This is the silver squeeze top over here when it was about 65, 63, something like that to 1. And we've hit the trend line again over here at about 76-to-1. Is that the number, 76? I can't tell. The red line's like probably a 6, yeah? So we have to break this trend line to get to the next major silver rally. And I think we will pretty soon. We'll see if we can break it here. We might have a little bit of a bounce and then a breakthrough. Once this trend line breaks and it's a 12-year, 13-year trend line, I think we're going to be in for some fireworks, is the point. I wanted to talk about this week. This is speculation on my part. The case isn't that strong here, but I just wanted to make it anyway as a possibility. So I looked at the charts from 2010 to 2011. And if you remember a few weeks ago on the silver report, I talked about the top in the 1970s at 650, corresponding to the top in 2010, the triple top at 650 in the 1970s, the triple top at 20 going into 2010, 2011, and now the triple top at 30 that was recently broken, and now we're on our way higher. This is from the triple top at 20, this final break over here in September 2010. You can see here the low in that week. This is a weekly chart. The low was 1959. So I looked at the daily charts. I didn't put that daily chart in here. It's too tedious, but just trust me. The daily chart shows that after we broke 20 for the third time, we were trading below 20 for about 4 trading days until the trend was sustained much higher to another local top about 30, 31. And then we had about a 1 month decline here and then all the way up to 50. So yeah, 4 trading days below 20, and that is very similar to what's happening now. Why? Because this is the daily chart of the 2024 break of 30. Just like in 2010, we had a triple top break of 20. Now we have a triple top break of 30, which corresponds to the CPI. And I went through that about 3 weeks ago. Check the other silver reports and you'll see it. And so here's 30. We had a break of 30. And if you go down here, we had 3 trading days where we traded below 30 despite breaking the triple top at 30. It was 3 trading days breaking below 30, just like we had 4 trading days breaking below 20 before we headed to another top. I'm surprised that we only broke through 30 very briefly. I thought we were going to go to the 50-week moving average here, or 50-day moving average here. Yeah, the 50-day moving average. I wouldn't be surprised if we went to 28, but we didn't go that low. So we'll see what happens here. It looks encouraging. And could it be that this will be a repeat of 2010 where we broke 20 briefly and then headed up to 30 and then to 50? It could be. I'm not predicting it necessarily in the next few months, but the point is it could happen and you got to be in, and don't be surprised if it does, because when it does happen, it's going to surprise everybody. I promised that I would talk about the more extreme case than 75 ounces of silver for a house in Germany, in Weimar, Germany in 1923. So this is from the Diary of Benjamin Roth, a book that I'm reading, A Great Depression, a diary, page 121. So I highlighted here. If you want to try to make out my handwriting, then you can try to tease out the reason that I figured out that this happens. This is common sense back in 1933. Not everyone had common sense back in 33, but Benjamin Roth had a fair amount of it. So he says, inflation is a terrible thing, and I hope it will never come to America. This is entries from July 1st, 1933. It penalizes saving and changes the entire outlook of the prudent investor from government bonds, life insurance, etc., to speculative stocks and commodities. Yes, we all know this. It's the same now. The German mark before the war was worth almost 25 cents in American money. When inflation ended, right, in 1923, it's talking about $1 would buy about 1 billion marks. During inflation, American speculators went into Germany and bought huge pieces of valuable real estate for sums as low as $50 in our money. Hunger, starvation, and ruin were the results of German inflation. In no country has it ever proven to be a blessing. So $50 for a valuable piece of real estate. He's not specifying here exactly what valuable piece of real estate that could be. I'm just saying it's a house, or it could be a building, or whatever it is. So $50 at $20.67 is about 2.4 ounces of gold for a house. Multiply that by 16 at a 16-to-1 historic monetary ratio for silver, and that's about 39 ounces of silver for a house. So 75 ounces for a swanky, nice place in Berlin, and 39 ounces of silver for a run-of-the-mill family home, let's say. I still believe this is going to happen.
During the interview, Rafi Farber observed that the Dow-to-gold ratio, which peaked at 19-to-1 in 1929, is currently at a similar level, suggesting a potential market shift. He highlights the importance of holding precious metals during economic downturns, as those who did so during the Great Depression fared better than speculative investors. Today, the Dow-gold ratio sits at around 17, very close to where it was just before the 1929 stock market crash. As the Dow Jones Industrial Average hits the record-high 40,000 benchmark, stakeholders are experiencing almost picture-perfect conditions in other investment options too. The Wall Street Journal reports. It notes that tech stocks, cryptocurrencies, and gold are ticking up, and even lower-risk investments, such as certificates of deposits, are hitting 5% yields. Regarding gold's current market position, Farber pointed out that open interest in gold futures has decreased to 440,000 contracts. Despite this liquidation, gold prices have remained stable, indicating the potential for future price increases as new contracts are opened. He predicts that with the current setup, the market has enough fuel for a significant rally in gold prices. Let's get back to the interview.
This chart I conjugated from Gold Charts R Us. Really, they conjugated it. I just brought it up. Stuck at the 1929 Dow Jones top. By the Dow Jones top in 1929, right before the crash of 1929. I'm in a Great Depression mood because I'm reading a diary about the Great Depression, and I'll show you the entry at the end of these slides about the more extreme note that I found than the 75 ounces of silver for a house in Germany, even more extreme than that, and it's at the end here. But anyway, stuck at the 1929 Dow Jones top. This is relative to gold. So the Dow relative to gold was about 19 ounces to buy the Dow, and this was in 1929. And you can see here that we've been stuck in this range. since about 2018, it looks like 2019. I don't know the exact year, but in the last 5-6 years, that's where we've been stuck at the 1929 top of stocks versus gold. The second bubble was in the 1960s, 1970s with the fall of the London gold pool and the end of convertibility, the closing of the gold window by Nixon. That led to a collapse of the bubble in the 1970s. And here we have the third bubble, which was the most extreme of all, into the 2000 top, into the NASDAQ top. And we haven't gotten anywhere near that spectacular bubble again. We're stuck at the first bubble top in 1929. Also, I wanted to put some perspective on this Great Depression over here. On this gold to stocks ratio, gold to Dow ratio, or Dow to gold ratio, whatever it is, when we're down over here, the problem, what makes people poor in a depression is not necessarily that stocks are not expensive relative to gold or they're really cheap. It's that people bought on the way up over here, and then they had to sell and they lost all their money. So you have cheap stocks, but nobody has any money. And it's the same thing with other goods and services. They can't afford food. They can't afford shelter. They're very poor, and it's a depression. But if somebody just held on and didn't participate in this bubble and just held on to their money, meaning their gold and their silver, not necessarily their dollars, because again, the dollar is a derivative, then they would have been fine. They would have been able to pick up a bunch of stuff at a discount. Same thing over here, 1970s, 1980s. This was also a depression, but you see here, the Fed tried to pump up the bubble again, up to about 22 ounces of gold, but haven't gotten anywhere near the second or third bubble tops. So we're waiting for this final one to deflate, or this half bubble to deflate, and that should lead us to the end game in my estimation. Let's go to the next slide. So gold open interest. This is important for traders. It looks like we are down to about 444,000 contracts. I think that was the low. I think it went a little bit lower than this. This is from 2 days ago, this chart. But it's around here, and we see that we have liquidated on the open interest in gold futures from about 540,000 contracts to about 440,000 contracts. It's about 100,000 contracts liquidated since mid-May. And the price of gold has not gone down. They've gone from highs of about 2,450 to about 2,400 now, so about $50. That's not really anything these days, meaning we have plenty of fuel for new contracts to be opened and the price to head higher. Whether it starts now, I do not know, but the fuel is there to make it sustained once it does start. And we see a longer term view going back to 2022 of open interest. We can see that we are in the average range that we've been in, below average, really. I mean, I think most of the time we were on top of here, and we see here the peaks, and we're way below that. So yeah, we can go a little bit lower in open interest, and that would be helpful. The low was 400,000 over here, and this is when I was calling for a pretty big rally, which is exactly what happened over here. This was a major low, and then we've been rallying ever since. So yeah, open interest numbers in gold look good. We have the fuel for another takeoff. Exactly when it starts, we'll see, but the fuel is there.
Despite the optimistic scenarios, there are significant hurdles to silver's rise. Market conditions are notoriously unpredictable, with factors such as technological advancements, changes in industrial demand, and shifts in investor interest, potentially altering the silver landscape drastically. Given these insights, how do you think these trends will impact your investment in precious metals? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.